What's up, people? Welcome back to Invest with T Claus. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Neo, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. If you had done a quick search for some of the big headlines this week, this is likely what you would have seen. News around the Nvidia 10-to-1 stock split going into effect, the stronger than expected job report at the macro level, and lots of headlines around the GameStop frenzy. Interestingly enough, GameStop does play into today's topic of ChargePoint. How? Stick around if you want to find out. But with all those major headlines, it would have been easy to miss the fact that ChargePoint 2 had a big week. Earning results were delivered a few days ago on June 5th, and the news was good. The stock closed Friday at $1.80, up 7.14% for the week. I told you in my last video, and you can catch it here, that things for ChargePoint are turning around, and now the results are in. So in today's video, I'll go over some of the highlights and main takeaways from the earning call, then take a look at the analyst ratings, some changes here, and I'll close with what I'm personally doing as far as buying, holding, or selling. This is where GameStop comes into play. As always, this is not to be taken as financial advice. I'm not a financial advisor. This is my personal approach to investing and the thought process behind it. I'd recommend watching all the way through so that you don't miss out on anything pertinent I will be sharing. Drop the video an early like if you haven't already, and smash that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. The stock price has been range-bound and consolidating just above the 50-day moving average. That's $1.65 for reference. The fact that we remain above this level post-earnings is a positive sign. As a reminder, before we get into the results, ChargePoint fiscal year 2025 is equivalent to calendar year 2024. It's also worth noting that ChargePoint commitment to prospect investors and current shareholders is to achieve positive non-GAAP adjusted earnings by the end of this year. And so with that in mind, they reported a quarter-over-quarter improvement in gross margins from 22% to 24%, essentially almost fully recovered to where we were a year ago at 25%. Considering we had significant negative margin of 18% just a couple of quarters ago, this is a strong step in the right direction. Operating expense is the lowest it has been in the past year, 62% versus 65%, which is an improvement from last quarter, and also an improvement over last year at 66%. Revenue came in at $107 million, which is down 18% year over year. They break down revenue into two buckets, that's network charging and subscription revenue. Network charging was down 34% year over year. However, subscription revenue was up 27% year over year. This is important because most of the margins are made on subscription revenue. Net income loss improved on a year-over-year basis. No matter which accounting method you utilize, we saw a reduction in losses ChargePoint has incurred. Looking at the non-GAAP adjusted loss metric, they saw an improvement of 25% year over year. When you put it all together, and what this boils down to is a beat on earnings per share. Expectations were for an EPS loss of 13 cents. ChargePoint delivered an actual EPS loss of 11 cents. They have now beat expectations 2 quarters in a row. It's also worth noting that because they have been managing their capital and cash reserves more efficiently, they have not had to draw on their credit line, which is a positive for not taking on more near-term debt at a higher interest rate. When it comes to forward guidance, they stayed conservative by providing a similar range to this past quarter. Guidance is for revenue between $108 million and $118 million. They did note during the call that they expect revenue to further improve as the year goes on. It's evident to me that the company is making incremental improvements and are dead set on proving that they can and will absolutely deliver on the commitment they made to shareholders in order to 1, rebuild that trust, and 2, most importantly, regain a higher allocation in most investors' portfolio. And so when you think about it, between scoring a massive partnership like the Airbnb deal I previously covered, and the business highlights around the ChargePoint network expanding to 1 million locations worldwide, access to government contract through FedRAMP, and access to grants for ChargePoint customers, making it easier for them to purchase ChargePoint goods and services, it's fair to say that ChargePoint is indeed focused on improving performance, and it is showing in the results. As I was looking to evaluate sentiment around the stock, as well as how analysts were re-rating it post-earnings, I'd say that sentiment is overall positive, but there's still a decent amount of caution out there, and rightfully so. The overall consensus rating is a moderate buy. The total number of ratings has dropped from 12 down to 10. No particular reason other than some analysts have not updated their ratings post-earnings. The breakdown is as follows. We have 5 buy ratings, 4 hold ratings, and 1 sell rating. The high end of the range is now lower at $4.25 versus the $6 prior. The low end is unchanged at $1.50. The average consensus price target is also now lower at $2.97. Despite the reduction in the median price target, it still represents a 65% increase from the current level and over double the returns when we reach the top end of the projected range. But to get there, we have to build a strong base, right? The stronger the base we build here, the more sustainable the next move past the psychological resistance of $2 will be. Earlier, I told you that GameStop somehow factored into the calculus, and it did. Here's how. All the noise around GameStop, the upcoming live stream set for Friday, and the $70 price target to make Roaring Kitty a billionaire. He's the figurehead around GameStop trading, if you didn't know. With all of those upcoming catalysts, there was massive momentum building up. I saw the opportunity and took a position with the stock around $30 on Thursday morning. The stock from there skyrocketed to a ridiculous $66 by the end of the day during after-hours trading, and with my single day gains with just over 100%, I cashed in my profits. I'd say that it was timely as the stock returned all of those gains the very next day on Friday and now trades around $28. The reason this is relevant and why I'm telling you about it is not to pat myself on the back and say, look how good of a trader I am. It's more that sometimes you can use these trading opportunities for quick gains to grow your long-term position. And so I took part of those gains and rolled that right into ChargePoint by adding another 200 shares to my portfolio. In my last video, I told you that now was once again the time to load up on ChargePoint, and that's exactly what I'm doing. And here's another interesting fact. When you look at the chart on a much longer time horizon, you can see that since the all-time high in December of 2020, ChargePoint has been on a downtrend, right? But even more interesting is that we've been relatively flat since October of 2023. The stock continues to consolidate, and the improved execution at ChargePoint is slowly but surely ushering in a full-on reversal. I've made the comment before that I see the stock climbing more meaningfully once rate cuts go into effect and ChargePoint delivers on the promise of positive non-GAAP earnings. So really, we are looking at Q1 next year for some of the caution to fully dispel, and that's not very far away. It's a fact also that ChargePoint is the #1 charging provider ahead of Tesla and Blink. The exact figure according to the Department of Energy in the US has ChargePoint operating 56,000 of the available 141,000 charging ports, including level 2 and level 3 chargers. And so the last thing that I will share with you, and this is a fun fact from PwC, one of the big 4 consulting firms globally. According to their research, and I quote, the EV charging market will have to grow nearly tenfold to meet the need of the projected 27 million EVs that will be on the road in 2030. It projects that the electric vehicle supply equipment market could grow from $7 billion, that's billion with a B, today, to over $100 billion by 2040, a 15% compound annual growth rate. And they conclude, if ChargePoint can hold its top position in the EV charging station market, its long-term upside could be massive. End of quote. The bottom line here is quite simple. Buying ChargePoint here puts investors virtually on the ground floor with massive upside potential, kicking in as early as next year, in my humble opinion. These earning results show that the company is heading in the right direction, and this could very likely be the start of a multi-year uptrend. Is there a risk? Absolutely. But guess what? Electrification is not stopping, meaning that the reward here will be more than worth it. That's just my perspective, and for that reason, I am absolutely a buyer. But on that note, that is it for me today. If you found value in my content and feel so inclined, super thanks are appreciated. Simply click on the thanks button at the bottom of the screen and select the amount you're comfortable with. If you want to learn more about super thanks and how I use them, you can watch this video here. Remember to click the like button and share with others who you think could also benefit from it. For my newcomers, subscribe. It's free, and don't forget to ring the notification bell so that you too can stay in the know. I'll be back next Sunday for my weekly video and possibly during the week for an extra one. Till then, you can keep up with me here on X for crypto and NFT related news. Thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.